Think about this. Isn't science amazing? From the tiniest atoms to the vastness of space, it helps us understand the world. But what about the world of business? The world of buying, selling, and making things? Well, there's a science to that too. It's called corporate finance. Now, I know what you might be thinking. Finance, Bill? That sounds complicated. But hold on a second. At its heart, finance is just a way of telling a story. It's the story of a business, written in the universal language of numbers. Are you ready? Let's get started. In the big library of business, there are 3 books you absolutely need to read to understand any company. They're not dusty old novels. They're more like essential guidebooks. Each one tells a different part of the company's story. Reading all 3 together gives you the full picture. The balance sheet is a photo, the income statement is a movie, and the cash flow statement is a river that tracks the money. They work as a team to give you a clear understanding of past performance and the current situation. Understanding these basics is a superpower, asking smart questions and making informed decisions. It's not a scary monster, it's a tool anyone can learn to use. We'll even build our own little lemonade stand business to see these ideas in action. Let's dive deeper into our first financial document, the balance sheet. Think of it like a photograph. It's based on a beautifully simple and powerful equation. Assets equal liabilities plus equity. It must always balance. Assets are all the valuable things a company owns. Cash in the bank, inventory, buildings, machines, patents, and trademarks. Liabilities are what the company owes. Bank loans, bills to suppliers, wages due. Equity is what's left for the owners. Assets minus liabilities equals equity. If you sold all your assets to pay off all your liabilities, the money left over would be the owner's net worth. And remember, the balance sheet must always balance. It's the foundation of all finance. To truly grasp one of the most powerful tools in business, the balance sheet, we don't need a complex corporation. We just need a simple idea. So let's build a business from scratch. Let's set up a lemonade stand. The principles we'll use are the exact same ones that guide giants like Apple and Amazon. It all starts with understanding what you have and where it came from. Every business needs capital to get started. First, I'll invest $30 of my own money. This isn't a loan, it's my personal stake in the venture. In the world of finance, this is called an equity investment. It represents my ownership. If the business succeeds, the value of my equity grows. If it fails, this is the money I stand to lose. But $30 might not be enough. So I'll also borrow $20 from my friend. This is different from my equity. My friend doesn't own a piece of the stand. They are a lender, a creditor. The business now has a legal obligation, a liability, to pay that money back. This is known as debt financing, a common way for businesses of all sizes to get the funds they need. Now with our initial funding secured, we can create our first financial statement. Let's take a snapshot of our business on day 1, before we even sell a single cup of lemonade. This snapshot is the balance sheet. It doesn't show motion or sales over time, it's a static picture of our financial health at this very moment. We'll start on the left side with assets. Assets are any resources the business owns that have future economic value. Right now, our only asset is the cash we've collected. So, under assets we write, cash, $50. For a larger company, assets could also include buildings or equipment, but for us, it's this cash. This $50 isn't meant to just sit there, it's the economic fuel for our business. We'll use this resource to buy our inventory, lemons, sugar, and cups. The entire goal is to transform this cash into products, and then transform those products back into even more cash. We're putting our assets to work. Now for the right side of the balance sheet, which explains where the money for our assets came from. First, under liabilities, we list what we owe to others. We write, friend loan, $20. This is an external claim on our assets. This brings us to the fundamental accounting equation. Assets equals liabilities plus equity. Our total assets of $50 are perfectly balanced by the $20 in liabilities and the remaining $30 in owner's equity. It has to balance. Every dollar the business has, an asset, must be accounted for as either a debt to someone else, a liability, or a claim by the owner, equity. And there it is, our day 1 balance sheet is complete. With our resources accounted for, we're ready for business. We'll sell each cup for $1. Now, the story shifts. The balance sheet showed us our starting point. To see if we're actually successful, we need to track our performance over time. For the first week, we'll record all our sales and costs. This will create our second key financial statement, the income statement. Time to squeeze some lemons. Let's see if our little economic engine can turn a profit. The income statement tells the story of our business over a period of time. A movie, not a photo. It tracks performance for a week, a month, or a year, showing the flow of money in and out and revealing the plot of our financial narrative. Its main goal is to calculate the legendary bottom line, net profit. This single figure answers the most fundamental question. After all costs are paid, did we actually make money? It's the ultimate measure of a company's profitability. The story starts at the top with revenue, all the money earned from sales. For our lemonade stand, we sold 100 cups at $1 each. So, our total revenue, or top line, is a crisp $100. But it takes money to make money. First, we subtract the direct costs of making our product, known as cost of goods sold, or COGS. For us, that's $40 for lemons, sugar, and cups. Revenue minus COGS gives us our gross profit. So, $100 minus $40 leaves $60 in gross profit. Next are operating expenses, or OPEX, the costs of running the business. This includes our $10 marketing flyers and a $5 park permit. These are essential, but not part of the product itself. Total OPEX, $15. Now for the finale. We take our gross profit of $60 and subtract our operating expenses of $15. That leaves us with $45. This is our net profit, the true bottom line. If this final number is positive, it's a profit. Hooray, we're profitable. If negative, it's a net loss. A critical sign the business model isn't working. A loss means we're spending more than we're making. So the income statement is the ultimate financial report card. It doesn't just give a pass-fail grade, it shows the business is performing. It helps us analyze our pricing and costs, providing the insights needed to make smarter decisions for the future. Finally, we arrive at our third key document, the cash flow statement. While the income statement measures profit, it often uses accrual accounting, recording sales before cash is received. The cash flow statement cuts through that. It focuses purely on the actual movement of money, tracking every dollar that flows in and out of the business. This distinction is vital. A company can be profitable on paper but still run out of cash, a common reason businesses fail. Imagine we make a huge sale on credit. The income statement looks great, but we have no cash to pay for our lemons and sugar. Cash is the oxygen a business needs to survive. Without it, a company can't pay its bills or its employees. To understand where the cash comes from and where it goes, the statement is broken into three parts. First, cash flow from operating activities, the money generated by the core business. Second, investing activities, which involves buying or selling long-term assets like equipment. And third, financing activities, which covers cash from owners and lenders. Let's start with operations. For our stand, operating cash flow is the cash from customers minus the cash paid for supplies. A positive flow here is a fantastic sign. It shows the fundamental business is healthy and can sustain itself without needing outside funding. Next, investing. We spent $40 on a table and a pitcher. Since these are long-term assets that will help us for a while, this is an investing cash outflow. It's a purchase made to grow the business's future capabilities. If we later sold that table, the money received would be an investing inflow and financing. The initial $30 from the owner and the $20 loan from a friend were financing inflows that got us started. If we later repay that loan, that payment would be a financing outflow, returning capital to our lender. The statement then sums it all up. It shows how the cash at the start of the period, plus or minus the net cash from these three activities, equals the cash at the end. This final number perfectly matches the cash on our balance sheet. It provides a clear picture of a company's ability to generate what matters most: cash. The three statements, read together, tell a complete story of the business. Entrepreneurs, managers, and investors use them to plan, compare, and make decisions. An income statement can show if our lemon costs are too high. A balance sheet shows if we have the cash to invest elsewhere. Profit explains the increase in equity, and cash flows explain why cash changed. You can continue with financial ratios and forecasting to refine your decisions. These same principles apply to big businesses. The numbers get bigger, but the ideas stay the same. You've unlocked a new way to see the world. Keep asking questions, stay curious, and never stop exploring. Thanks for watching. If you want to go deeper, subscribe and check out our resources to learn ratios and forecasting. See you soon.